Our second panel subject will be, what can a financial advisor do for me? There's more to financial planning than investment advice. Financial Advisor IQ reporter Chris Latham moderates the panel on how advisors help with wills, insurance, college savings, and financial planning for life. So with that, allow me to introduce our moderator and panelists. Chris Latham, reporter for Financial Advisor IQ, which is a money media publication owned by the Financial Times Company. Chris's experience in depository receipts, global banking has taught him how to analyze industry trends, economic factors, competitive positioning, and client needs. He has also worked at the New York Federal Reserve, and he has an MBA from the University of Illinois at Chicago. Welcome, Chris. Joining Chris as panelists today, we have David Washour. David is a CHFC and CLU financial planner since 2004. He is the founder of the Wealth Plan, a comprehensive financial planning and wealth management firm with a specialty in retirement income planning. Welcome. Also joining us today is Kimberly J. Howard. Kimberly is a CFP and owner of fee-only financial planning and investment management practice in Newton, Mass. And Denver, Colorado areas. Kimberly is also a frequent contributor to local and national media, including our own Advice IQ and NerdWallet. Welcome, Kimberly. And then lastly, Tim Mora. Tim is a CFP and wealth advisor working with individuals, families, and organizations at Buckingham Asset Management and the director of personal finance at the BAM Alliance. Tim taught financial planning at Towson University in Maryland and is a regular CNBC contributor and writes also for Forbes.com on a weekly basis and for Money on a monthly basis. Tim is also co-author of the book, The Ultimate Financial Plan, Balancing Your Money and Life. So with that, allow me to turn the floor to Chris and the subject, what can a financial advisor do for me? Thank you.
All right. This panel today is going to explore what financial advisors do for clients in addition to investments. As a matter of fact, when the public hears the words financial advisor, they often think salesperson. But an advisor does things in relation to retirement planning, estate planning, insurance, college funding, and small business ownership. So why does the public rarely think of advisors for those services? Tim, why don't you start us off?
Chris, I think the reason the public does not think of advisors and more as salespeople is because the industry has effectively earned that reputation. For a couple hundred years now, financial advising has effectively been based on product placement through major proprietary entities. And I think now we're starting to see the evolution into more of a professional realm of financial advising. And if you think about it, even the phrase financial advisor, it's comprehensive in nature. So I think that still to this day, many people think of financial advisors synonymous with whoever it is they know who calls themselves a financial advisor. That person may be a stockbroker, maybe an insurance salesperson or a banker. But I think now we are really starting to see the evolution of the industry into a professional realm where financial advising is truly a comprehensive endeavor in addition to just selling insurance or investment products.
Kim, what do you think?
Well, I think one of the things is that what I've kind of experienced and seen is that clients want to get rich fast, or people want to get rich fast, and kind of the sales technique or the stockbroker technique kind of promotes that. It's, that's the only focus is on making your money grow. And there's other aspects of that help overall, like if I could cut back some of my expenses, then I'll have more money to make it grow. And those types of avenues aren't necessarily explored by the stockbroker or salesperson.
All right. David?
Yeah, I want to just thank Advice IQ for having me and all the sponsors. It's truly an honor to be here and extremely flattering. I I just look at it, there's, three different generations of this industry, and the first was a very transactional-based relationship. You're a stockbroker, you're an insurance agent, and then the push was more towards a fee-based relationship where you're charging a percentage under assets. Once that happened, you now have this really long-term relationship because it's not about selling someone a product. And the third generation where we are today is this ongoing comprehensive planning relationship where you truly are helping clients from everything financial planning A to Z because you have that long-term compensation incentive. You're always receiving the compensation, you're always helping the client, and you just need to do more than just push a product.
All right. Speaking of products, like I said, this panel is about more than just investments, but investments themselves do require some decisions that have nothing to do with the markets. For example, a client's values and goals. So how can advisors use those more abstract forces, values and goals, to connect the client's investment strategy to their other financial needs? David, why don't you continue that thought?
Yeah, I mean, to me, I do comprehensive planning in my practice. I actually write written financial plans so people have a simple Word document of everything they need to know. So I don't know how you could possibly advise a client if you don't know their values and goals. To me, investing is not a goal. Investing is it's a pathway to get to the goal. So, you need to do comprehensive planning and advice to really understand the situation. So you just got to sit back and listen and let the clients tell you what they want, and then you can deliver what they need.
What do you think, Tim, about the listening for values and goals?
I think that the words values and goals have been thrown around in the financial world for a long time, but I think they're really just starting to be utilized. A lot of advisors think of themselves as a specialist in, say, investment management or insurance or estate planning, whatever it may be, and they feel as though they're not qualified necessarily to go to this deeper level of discussion. But I encourage advisors, look, it just starts with a conversation. Do you have a difficult time finding out who your friends in your neighborhood or at your kids' games do you have a difficult time finding out what it is that they want to be about in this world? No, through just regular conversation, we learn what someone's values and goals are. But I think there's also a burgeoning group within the financial planning realm, often referred to as life planning. George Kinder began this movement, I think. Rick Kaler and Ted Klontz have done a great deal to facilitate advisory relationships and understanding in this regard. And Money Quotient, based in the Pacific Northwest, is a nonprofit that actually creates tools for advisors to use to figure out the intangible elements in a more tangible way.
So, Kim, when it comes to these intangibles, values, and goals, do you find that clients are eager to actually share that aspect of their life with you?
I think it's a little tough. One thing that I kind of incorporated is kind of to get clients to come about how they view money is we draw out a genealogy chart, and then we kind of look at each piece and how those, either their parents, their grandparents, their siblings view money, and then they kind of bring in how their concepts are. And then they can kind of see, oh, maybe I can change those, but I have a concept of where it's come from so that I can move forward and change going forward through that process.
So you sort of have to look backwards in order to see where you are and go forward.
I think it helps. If you're looking at how you view money and where money's come from and how it's used in your family history.
All right, let's talk about some specific services now. Retirement planning is about more than simply allocating assets into a 401k or an IRA. But there are aspects of retirement planning that people tend to overlook, but that advisors can help them focus in on. What are some of those aspects when it comes to planning out one's golden years that an advisor can draw a client back to relevant points for retirement?
Well, I think one of the biggest one is longevity. Because, I think a lot of clients, a lot of investors think that they're not going to live as long as they probably are. And so is that money going to last for that length of time? Some of the other things is Social Security, when to take it. There's many different options in order to do it. You can file and suspend. You can have spousal benefits. So there's a number of things that kind of go along with that kind of give clients more than just, what's my number that I need? And because the question is always, is that money going to last and how much? So the other side is, expenses. their lifestyle. Is their lifestyle going to change drastically once they go into retirement, or is it not? Is it going to stay the same?
Well, one other issue is also that the longer you live, the more likely there'll be health-related issues, and the cost of those issues are in no way known at the current point. David, what do you think about how to get clients to think about some things they may be missing for retirement planning?
Well, a key part of a written comprehensive plan is the retirement income plan. So in my practice, I purchase software to help clients, and there's tons of assumptions you need to make. What age are you retiring? How long do you plan on living for? If you could figure that out. What rate of return assumption should you use? Your tax bracket, what inflation will be. So, with this software, I can illustrate different scenarios, but it goes back to what does the client want, after tax income-wise for the rest of their life, and you look at the different scenarios, and hey, you either going to have to work longer, save more, or spend less in retirement. So, you got to make a choice or a few choices.
Tim, do you find that clients tend to have unrealistic assumptions about what their retirement's actually going to look like?
I absolutely do, Chris. And I think that the financial advisory realm has done a really good job helping people figure out the technical aspects, the numerical aspects of retirement planning. But I think we've done a relatively poor job handling the lifestyle elements. I think that is one of the most stressful things anybody can do in this lifetime is retire. To go from being a fully productive individual with an income coming into the household to cutting off that income flow, trying to generate it from elsewhere, and then also trying to figure out what the heck am I going to be about in life for the remainder of my days. The medical community is pointing to this truth that I think we struggle with, that we're not actually meant as humans to just do something until we're 60 or 65 and then kick our feet up on the beach. I think that's a big conundrum that we as advisors should be walking through with their clients so that they're not just taken care of numerically or economically, but also emotionally.
All right, retirement's one aspect of a longer lifespan, but then there's the end-of-life consideration. So estate planning. Most people lack a fully formed estate plan, which can include structures like wills and trusts, which is understandable because very few people actually like to discuss the prospect of their demise, but it's necessary. So under what circumstances do you think that an individual should create an estate plan and then subsequently update those related structures? David, why don't you take this one?
Well, estate planning has always been tough for me to get clients to do because of it's just not a fun, it's not a fun thing to discuss. But I try to position it by saying, listen, everyone has an estate plan. It's just dictated by the state you live in. So if you don't want the government to decide where your money goes to and who makes decisions for you, should you become incapacitated, you really need to create your own estate plan. And I always defer to an attorney, someone who specializes in this. I look at it as a completely different field. I give clients basic advice and guidance, but the professional has to give them that advice and walk them through it, because it truly is case by case.
Tim, do you feel that estate planning is almost a completely different field than advising?
Well, I agree with David completely that we need to have a professional estate planning attorney too, not just any attorney, but an estate planning attorney involved in the creation of the documents. But I do believe that it's actually one of the most important elements of comprehensive financial planning. When folks ask me the question, what is the most important thing I should do now? We've got a very broad field that is in financial planning. But I know the answer every time is, do you have your estate plan updated, especially for that demographic that would anticipate they don't need to worry about it yet, that 30-something couple who now have a couple of kids. If they don't have estate planning documents, to David's point, it means the state is going to decide who becomes the parents, the subsequent parents of their children if husband and wife go off on the cruise and the boat goes down, right? Because that dictating who the guardian is of those children, in my opinion, is the most important financial planning recommendation above and beyond everything else, especially for that demographic who has minor children. So I agree, yes, that it is a subset and requires additional professional help from an attorney, but I believe that it's something that we really should have in the forefront of our minds as advisors as a red flag.
And speaking to the point of the updated estate plan, Kim, under what circumstances should wills and trusts actually be changed based on life circumstances?
Well, I think anytime there's a major event, whether it's divorce, new children added to the family, definitely that time. Any major life chance, getting married, starting a business, any of those kind of brings into play, because if you don't, then it may be out of date. You may have, or even a separation, causes it. I have a client recently been separated for 15 years, and said, well, I think I had a written will someplace, and most likely I did it with, my husband. It was 15 years ago. Is it still in play? And I go, yes. So that kind of comes up that, she really wanted all her kids to have any assets. But right now, that simple will is out there someplace, and it's still in effect.
All right. Now, speaking of services that may be within the advisor's wheelhouse or tangentially related, insurance is one of those issues. Insurance comes in so many forms, life insurance, long-term care, disability, property insurance. They can be very complex, and they are far from universally beloved by both the general public and advisors. So that raises the question, who exactly needs insurance, and just how thoroughly should advisors explain any given insurance product to their client? Tim, what do you think?
Well, especially we were talking about the importance of estate planning. If your insurance plan is not lined up with your estate plan, then it doesn't matter. You could have a trust that you paid tens of thousands of dollars for, but if it's not properly funded, often through life insurance, then it's going to be completely worthless. So I think in many areas, especially insurance, what we're starting to see is that there's overlap in everything we do. You could have the best investment plan in the world, but you haven't helped out with estate planning. You don't have the life insurance planning linked up with the estate planning. All the work you've done is for naught if something bad happens in that household. So I think it's a vital component of the work we do as advisors.
David, how thoroughly do you explain any given insurance product if a client has a question or is considering it?
Oh, I go pretty deep on that. It's a major section of the plan. The broad category is protection planning. To keep it simple, life insurance, if someone is dependent on your income, and or you want to protect, your human capital, then you need to look at life insurance if someone is dependent on your income. Disability insurance, if you get sick or hurt and can't work, how are you paying your bills? So you need insurance there. Long-term care insurance, pre-retirees, retirees, you have accumulated assets, people are living longer than ever today. Home care in this country can run easily around $50,000 a year. A nursing home facility could run well over $100,000, $120,000 a year. So if you have accumulated some assets and you don't want those institutions to take your money away, you should look at long-term care insurance and or in conjunction with your estate plan, because there are ways to make yourself artificially impoverished in the government's eyes.
Kim, do you think every single person needs some form of insurance?
Well, I think that kind of plays into the fact of whether they can afford it or not. So talking about just life insurance, let's take that for example. If we have a single person, then and in their early 20s, then maybe life insurance isn't necessary at that time. It's always nice, but it's not really required, because there's not really someone else depending on their income down the road. So once that changes, either marriage, children, time goes on, then yes, I think it's important. But again, if the client can't afford to keep up with the premiums, then it becomes a question of, are they just taking it out for the short run? And if they can't pay it, then what's the situation? Is it meaningful or not? Is it desirable or not?
All right. Let's switch gears a little bit and look at some specific client demographics. So over the last few decades, the cost of college has soared dramatically, and graduates are coming out of school with increasingly burdensome loans in relation to their incomes. So when should someone in school begin speaking with an advisor, if at all? And under what circumstances should that be the start of a long-term advisory relationship concerning things that are not simply about college? Kim, why don't you start us off?
Well, I think it would be great if every college student started off talking to an advisor from the standpoint of taking out the loans, if they're taking them out themselves and not their parents, how they're going to pay for them going forward, what kind of learning just simple cash flow in college to how it's going to translate later on. Now, will all college students do it? Not always, and not many, if at all. When do I think that the real situation starts is probably once they're out of school, they have their first job, or they've gotten married, some kind of life-changing experience happens, and that's what I see mostly. I see clients coming to me when something major has happened, a major shift in their life has happened, and that's when they come. Should they have come sooner? Most definitely.
Tim, do you ever deal with anyone that has college planning needs while they're in school or just out of it?
Oh, of course, absolutely. One of the problems we have as an industry, unfortunately, is that those people who need financial planning advice can't always afford it. You know, my kids have had a financial advisor since they were about 5 years old, and we first instituted their allowance, but most of their friends can't afford me. And I think this is a problem that the industry has going forward. I had this discussion with one financial advisor, said, you know, isn't it a shame? Isn't it a shame that the people who are like 30-somethings who just got married and have a couple kids and the yellow lab and the white picket fence, isn't it a shame that they can't afford us? They actually need our help the most. Well, I think this is interesting. There are a lot of folks in the advisory community who are now bemoaning the advent of the robo-advisor movement, but I think in part it's coming to address a need that exists out there, that people need to be able to have access to financial planning before they actually have millions of dollars. And the industry has really not been ready to serve them, historically speaking. I think Cheryl Garrett with the Garrett Financial Planning Network, the fee-only network, has done an excellent job. She's been addressing this for decades now, but it's a big missing piece of the financial planning profession going forward that we do need to address.
Now, one of the things I've heard advisors say about college planning is that certain professions tend to lend to clients coming to advisors more than others. For example, people in law school, people in medical school do tend to seek out advisors, but then they tend to have high-paying careers. David, have you found that that is the case, that people that have professional degrees but still have loan burdens are more likely to seek you out?
Let me just kind of go back on the back point. I think for parents with kids about to go to college, I think it's important to make sure they don't accumulate the debt, that you kind of nip that in the bud. So I think a serious discussion needs to be had of, is it worth you getting $160,000 in debt when you're going to enter a job force that may not be so hospitable? So I think that's step one. Step two is now, the 18-year-old is now 22, 23. They're starting to enter the workforce. There is an issue with certain advisors won't service them. Some advisors who just charge a flat fee will give them advice. It is imperative those people get advice and get help. I happen to be a millennial myself, so I see my generation facing tremendous burdens, with their incomes and their planning and their student loan burdens. So I think it's important to definitely get help and find someone who can help you, because those years are the most formative of forming good money habits, making sure you set things up properly and you understand basic financial concepts. Unfortunately, in this country, I don't think we're getting the best education we can when it comes to personal finance. Yes, certain occupations will seek us out more because they're coming into a very high-paying job.
Got it. Now let's talk about another demographic. That would be the small business owner, because a lot of advisors' clients do own small businesses across sectors. But that raises an interesting question. Tim, what does a small business owner need with a financial advisor that they can't get from using directly an accountant, an attorney, and an insurance agent?
Well, I think anybody who's worked with small business owners is probably aware that it's almost a personality dysfunction they have. They're really, really good at something, and that normally is the basis for their small business. But aside from that, they struggle in many of the other areas. So the benefit, indeed the vital importance of having a financial advisor involved, in addition to your accountant, your attorney, is to weave everything together. Oftentimes, a specialist is just going to be looking at one piece of your situation, may just be looking at your business and not thinking about how it overlays into your personal life. These are the reasons that it's important to have a financial advisor taking a more comprehensive view of the small business owner's situation.
I've heard advisors use the phrase quarterbacking, quarterbacking the small business owner's interests. Kim, do you find that small business owners have needs that they get from you that they can't necessarily get from another professional?
Oh, definitely. And I think overseeing what what Tim was saying, is kind of overseeing all those and bringing everything together, because the accountant may not talk to the lawyer and the insurance agent, and if a small business owner is talking to each one, then it may not come together. And I look at it also, it kind of goes back to the old, life-work balance. And it's really for the small business owner looking at how their life and their work balance together, not only for them, but in their financial world, and how those come together and play out going forward.
And another issue that I've heard that small business owners have is that a lot of their wealth is tied into the business, which I would imagine creates very unique financial issues that can relate to their long-term values and goals. David, do you ever have conversations with small business owners in that regard?
Yeah, I mean, I have some clients that are small business owners. They're great, and they're people. They need all the things that everyone else needs, and then they just have this extra factor. They have this business that they need to manage. But to me, it's just one of the same. It's just another area of planning where there might be a little more complexity there. But the reality is, financial advisors have their core competencies. Some advisors do some things better than others. But at the end, they still need a comprehensive plan. They need asset management. They need insurance services. And they do need someone to quarterback that relationship and make sure that the I's are dotted and the T's are crossed.
Now, financial decisions can be very difficult to remain objective about for individuals. Just look at insurance or taking out a college loan. That can be a stressful situation. David, how do you help clients avoid emotional missteps in relation to their financial decisions?
The value of a financial planner, I think, is to be that objective third party that has no emotional connection here, that can kind of give you some objective fact-based advice, and that's critical. And when you can put it into context of a comprehensive plan, and you know what the client's dealing with, you know what's going on in their lives, clients have opened up to you, you're now in a great position to help them and say, hey, let's slow down, let's have a freeze moment, and let's figure out what are all your options, what are the pros and cons of each option, and the solutions figure themselves out.
Tim, how often do clients get emotional, and are there any particular trigger points that you've noticed?
They're always emotional, as are we. I think it's important to recognize that every single financial decision we make has both economic components attached to it as well as emotional components attached to it. And I think that one of the things that we have done as financial advisors to our discredit is to so substantially disconnect the emotions from the economics. I certainly see the benefit of being the objective third party, but because our clients' decisions always have emotional components to them, it's important that we are addressing those emotional components. For example, if their asset allocation should be X, because we know that's what's going to be best for them over the long haul, but they're going to struggle sleeping at night, that emotion is going to override the economic interest every single time. And I remember Ben Carson saying, as a neurologist, I was sitting at a speaking engagement of his once, and he said that in my work, I was taught from day one that I should be emotionally disconnected from my clients, because if something happens that goes wrong, especially in that world, it can indeed be fatal. And so that emotional connection would be a problem. He said, I have spurred that from day one. I have had an emotional connection with every single client or patient of mine, and that makes me better at what I do. And I've taken that advice and followed it.
Kim, how do you respond when clients become emotional about financial decisions?
I try to engage them and try to understand, I think, empathy and where they're at, and trying to get an overall idea of it. So most of the time I have I would think that 99.9% of my clients, or any potential clients that I have a phone conversation with, the very first word out of their mouth shows that there is some fear there. Fear of either working with an advisor, either trying to work with an advisor, getting the wrong advice, getting some advice that doesn't work with them, or even getting advice and they realize this is going to take some change on my part for that to go forward. So I think all those emotions come into play, and it is very emotional. It's all emotional. It's all part of their life. And like I said, most of the time I have clients that start relationships with me because something has drastically shifted in their life, and that's an emotional change too.
All right. Let's take a step back and look at all the services we've discussed: retirement planning, estate planning, insurance, college funding, and small business ownership. If one client needs financial services for all of those issues, can a single advisor really solve all of those needs? Tim, what do you think?
Well, I think a single advisor can't solve anything. It's really the client's effort moving forward with good advice that solves problems, not the great idea we come up with in the first place. I think most advisors are going to have a specialty, but we do have to recognize that if you're calling yourself a financial advisor, that means you're not calling yourself an investment advisor, an insurance advisor, a banking advisor. That is a broad title, and as a result, we must be qualified generalists across the spectrum of comprehensive financial planning issues. At the same time, we are likely to be a specialist in one or more of those areas. That means that we're going to have to likely be part of a team that has the depth and the breadth of specialty that we can point people in the right direction when our competencies have reached their end.
All right. David, what do you think about the generalist versus specialist aspect here?
You know, there are tens to hundreds of thousands of advisors in this country, each with different skill sets, backgrounds, that have their different focuses. You know, so for me, I think the ideal is to be a comprehensive planner, but you don't want to be a jack of all trades and a master of none. So you should, as a practitioner, you should know what you know really well and become great in that. But you should be able to talk the talk and help clients, connect them with other professionals if you are lacking. I don't do taxes. I don't prepare 1040s. I want my clients to work with an accountant. I want them to work with an attorney, and I want to build a relationship with those other professionals. So it really is based on what the advisor's strength is. And as a prospective client, you need to ask the right questions up front, so you know exactly who you're getting with that advisor.
So we have the team approach and we have the centers of influence approach. But in reality, Kim, how often does a client actually need all of those things handled? Like one client who needs all of those services?
I think most clients need almost all of them.
At some point in their life?
At some point in their life. It depends on if you're carrying them through for a lifetime, then yes, if they've started. If they're, getting ready to retire tomorrow and their children are out of college, then college funding is not on the table. So unless it's grandchildren funding, college funding. So I think that looking at all of it is imperative. Now, whether each client gets each piece, that depends on where they are in their life.
Right. For example, a client today probably doesn't need 6 different services in depth. But if you have a 30-year relationship with a client, over the course of that relationship, chances are multiple services will in fact come up.
Right.
All right. Now let's look at the reverse approach. How can any individual client know for sure that a particular advisor is best suited to solve one of their particular needs? David, how can the client know?
Well, the first thing you should do when you're looking for an advisor is do a little background check on them. And there's actually on FINRA's website, there's a broker check option where you could do the due diligence and see were there any complaints against this advisor, were there any settlements. So I have a one-pager that I can email anyone who wants, showing you how to do this search process and really investigating the advisor. Because if you're about to form, God willing, a 30-year relationship, you probably want to know if FINRA's gone after him. That's our regulatory agency. Once you've done the background check, I also, on this same sheet, made a list of great questions that I think you can ask an advisor. How are you compensated? What are all the costs? What do you specialize in? What are your weaknesses? So, as a prospective client, you want to ask the right questions, and then at the end, you'll like them, you'll trust them, you think their solutions make sense, you get that good feeling, but you got to ask the right questions, up front.
All right. Kimberly, what do you think about how a client can figure out that they've chosen the right advisor?
I think asking the questions is a big thing. And not only is what they specialize in, but how they work with. How the advisor works with the client. So the client should take responsibility and say, how do we work? How do you do things? Do you develop written plans? Do you not? Do you do virtual? Do you not? How long does each meeting take? Those kinds of things make it more accessible for the client and makes the client feel better about what they're going to get.
So Tim, do you find clients asking you tons of questions or prospects asking you tons of questions before they take you on as a client?
Absolutely, and they should. I think I agree with these guys 100% about the due diligence that a client should do prior to an engagement, but here's the bottom line. Ain't gonna know whether or not this is the optimal relationship until after they've moved down the road with that advisor, after they've gone through a major life transition, after they've gone through a major economic event. What the client needs to do is find out whether the advisor and who they are as a person matches up with their marketing and the answers to all their questions, because advisors are a smart bunch. They can find a way to answer questions the way that clients want to hear them answered, but that's not always the reality. And especially with the sales background that we have in this industry, many of us, I was taught by the industry to come up with objections to their objections, right? I was taught to find a way to answer the questions in such a way that I could gain a client. That doesn't actually do us any good, newsflash, because when we find out down the road that who we are and our words don't necessarily match up, that's not good for client or advisor.
All right, let's assume that the client has done their research and they've taken the advisor on board. When it comes to major financial decisions, the client is required to share certain information with the advisor. You know, if you're a small business owner and you're thinking of an exit strategy to leave your business, for example, there are a lot of things you need to tell the advisor. What is the client's responsibility in that regard? What is the client's responsibility in making sure the advisor has the proper information? Tim, what do you think?
Well, I think the client's responsibility is high, but not quite as high as many deem. I personally think that we're the ones holding ourselves out as the financial advisor. We're the ones who have regulatory organizations behind us making sure that we're doing what we're doing. I believe that we have a higher obligation as the advisor to be forthright about who we are, what we do, what our competencies are, than the client has in terms of their responsibilities. Certainly, they have the responsibility to do their due diligence, but we're the ones holding ourselves out as an advisor, and I believe that fiduciary obligation is a higher one than the obligation they have to figure out this world that they're just walking into.
Got it. Do we have time for one more question?
From you, Chris, yes, and then we'll open it up to the audience.
Excellent. All right, so here's the big question. What if a client strongly disagrees with an advisor about a financial decision? What is the client supposed to do? Kim?
Speak up. That's it.
Immediately.
Immediately.
Get emotional, get a rant about it?
Whatever they need to do, get it out there so then they can see how the advisor will respond to it.
David, do you agree?
Yeah, I mean, you know, you want to make sure that the client has provided enough data so you can give good advice. If they've done that and the client doesn't feel comfortable with, you know, the advice was given, yeah, they should not follow it. But a good advisor, I think, will present many different options, explain the pros and cons, and then say, well, which path do you want to go down? You know, no one knows the future.
Got it. Now, the reason I'm asking this is because theoretically, if the advisor is presenting a financial decision, they've done their research, they are the expert, they know it, but the client disagrees, and it is their money. So, Tim, what do you think?
The client is the number one expert on his or herself. Right? They know themselves better than we do as an advisor, so absolutely they should speak up. They should see how the advisor responds to their objection to whatever it is that the advisor is recommending. Maybe they come to a solution, but at the end of the day, ladies and gentlemen, we are the hired help as the advisor. The client is the boss, and if your advisor is not hearing you fully and you have too much of a disagreement, then you should walk.
All right. Thank you. I think we're ready for audience questions.
Do we have any questions from the audience?
Come on.
One right up front here. Is there a microphone? 1 second. This microphone's coming.
Family living trusts, do you use them very often, and if so, when and why? Family living trusts.
Family living trust.
Yes.
Well, I think there's certainly a time for them to be utilized. I think
To avoid probate or to avoid taxes?
I don't know that the avoidance of probate is necessarily the most important reason. And of course, you don't actually avoid any taxes by using a revocable living trust. You just establish some segregation between assets that may facilitate the reduction of estate planning taxes. I think that they're probably oversold, in my opinion. I think that there are folks, you've probably heard the phrase trust mills. That's all they do. They just crank out revocable living trusts because they cost two or three times as much as a will and the other documents. So I think that they're overused. In my opinion, there's absolutely an appropriate use for them, and that's partly our job to figure out when that is the case.
Yeah, I would just say that it's case by case. You know, you have to present your situation to the attorney, the estate planning attorney, and say, this is why it makes sense for you. Obviously, there's an incentive for them to, provide you with a trust. That's their product, so to speak. But, this is a more complex area of planning, and you want to get the right advice on it.
And most of my clients aren't in the asset range to need the trust. Most of them have less than $1 million assets. So that's kind of my situation on that.
Any other questions?
Does anybody want to know what it feels like to have one of these Britney Spears microphones on your head? Chris, you look great, by the way. I'm completely uncomfortable.
Thank you very much. It's the water bottle. Relax.
That's what it is.
I have a question. So a lot of time we find a lot of clients have a lot of questions in financial planning, but most of the time is they have income, they have asset, but all tie up to doing something else in their life. And what are some ideas or strategy have you guys implemented that leverage the asset? For example, using equity loans to purchase investments, or leveraging a life insurance loan to do retirement, or educational planning. Have you guys done anything like that in financial planning?
I think it's a great question. It reminds me of when we were discussing small business owners. This comes up an awful lot with small business owners. If we go by the book financial planning, we might say that you shouldn't have any more than 5% or 10% of your net worth in any single asset. Well, this isn't going to be the case for most small business owners. So at some stage of the game, we have to throw the book out the door and figure out what is really the most important thing to this client. Many small businesses, or business owners in general, they'll end up having a vast amount of their total net worth tied up in their business, and that may be precisely what they should do, right? So there are cases where we do need to say, all right, let's pull our eyes up from the textbook and not just give them the party line, but figure out what is the individual instance and client that needs to be addressed by an alternative strategy.
I think the key is there's so many facets to planning. There's so many different strategies that are out there. There's so many solutions that keep evolving to help the client. So, that's where a good advisor comes in to sit down, look at the case and say, these are the strategies in the realm of college planning. These are the strategies in the realm of assets under management. These are the strategies in the realm of small business. So there's a lot. And, I'm always reading publications, because the second I think I've mastered a certain area, there's like 30 more strategies that I have to incorporate into my plan. But that's what makes it fun.
And I think that what brings into the whole comprehensive planning issue is looking at each individual one and then looking at it as a whole. So that brings in the different strategies.
Thank you.
Any other questions?
Don't be shy.
Nope, there's one.
We're having a blast here.
So for
One second. He started first over here.
So for the young people that are coming into life, they've already accumulated some credit card debt at high interest rates. And do you recommend having them get in front of an advisor now, or pay the debt off and obviously pay the debt off? Kind of give me, they don't want to, first thing is go ahead and get it paid off first and then go see an advisor, because you're going to get an 18% return versus, what are your thoughts?
I'll take this one. So the case is someone is right out of school, let's say they have $80,000 in credit card debt, they have, let's say, $3,000 in their bank. In general, my advice would be, you want to have, there's two major goals here. There's debt reduction, debt payoff, and building the cash reserve. So the cash reserve is important for, emergencies or opportunities. So I would say 3 months of living expenses right in cash. So whatever discretionary income they have should be going towards knocking off the debts, because like you said, the interest rates could be extremely high, especially in the credit card realm, and building that safety net so if an emergency happens, they're okay. That's what I would advise first. There will be an issue with working with some advisors because there's, you're not going to really charge that client a fee. They can't afford the fee, but that's general advice that I would have a consultation with someone and try to help them as best as I can, as well as consolidating those student loans to at least bring that interest rate liability down.
Yeah, and I think that oftentimes, especially high interest rate consumer debt is seen as a recommendation of singular focus, like you can't do anything else until you get this taken care of. But of course, this individual has more goals and objectives in life than merely paying off their debt and assuring that they have the right amount of cash reserves so that they don't end up in that problem again is certainly one of the first that comes to mind, but there are probably additional. Do they work for a company that offers a match with their 401k plan? Well, at least taking advantage of that match, you're getting a 100% rate of return, and free money is hard to find these days. So there are many elements of financial planning that are going to come to bear, but what I do find, as you said, is that oftentimes the person who's in that situation in the first place can't necessarily afford the services, so self-education is going to end up playing a primary role. I hope they get their hands on the right book.
Yeah, and also I think that as far as credit card debt goes, is I've seen the avenue or the focus of we're going to pay all that credit card debt off and then we're going to cancel all those credit cards, and that's the worst thing in the world that can happen, because once you cancel all those credit cards, then your credit score just drops off the face of the earth. So I think that's one thing that they have no idea that that's how it works. So that's one thing. And then I think again, as soon as people get in front of an advisor, helps them more in the long run than not. But again, it's can they afford it and what works out the best. And I think that's kind of some of the things that comes into play with some of these organizations, whether it's NAPA or FPA, and the pro bono work that the organizations do that allows some of these people to come in and at least sit down for half an hour and get some free advice on how to move forward on some of those things. And sometimes just a simple, how do I do this? How do I move forward and save and look at other aspects too helps them go a long way.
There was one more question back here.
Sometimes in medicine, it's one of the first questions a patient will get from a doctor is, why'd you wait so long to come see me? You're going to be dead in 10 minutes. Why didn't you come sooner? Do you get a lot of clients who express some guilt about not having come in to see you sooner? And if so, how do you address that?
There's no question one of the things I've probably heard the most from somebody who I've just gone through a really comprehensive plan with and we got them on the right track is, man, I wish that I would have met you 20 years ago. I know that every financial advisor in the room has heard that before, but I do think actually that you used the word guilt, and that I think is something that stands in between an awful lot of good clients and advisors. They don't want to go to the advisor because they know that the advisor is going to expose a whole number of things that they realized they should have done. You've probably heard the phrase that we have a tendency to should all over ourselves. And I think as advisors, we can also fall into too much of a pattern of being the authoritative, condescending tone. We can help assuage the guilt of our clients by diverting that emotion and addressing it in another way.
I personally have heard it a lot, but I view this relationship as collaborative, and at the end, this is where you're at. We got to make sure we get you to your goals. I think people are going to work a lot longer than normal retirement age is today, just because of the economic reality of it. So let's come up with a plan now, and better late than never.
Yeah, that's my viewpoint too. And like I said, 99.9% of my clients have come because of something major has changed in their life. And that is, they feel guilty that they shouldn't have started earlier. And I just view it as, at least we're starting today and moving forward.
Chris, I think that title of the session is, what can a financial advisor do for me? So I had one question asked of me earlier that I'd like to offer the group before we close, which is a bit more on the practical side. The person said that they are a parent, have 4 kids, teenage kids, and they have life insurance. But aside from life insurance, what other types of insurance should they be thinking about?
I was going to say, with clients, I look at long-term care, trying to figure out what makes sense and what doesn't, if that's something that's for them. I think I also, when I sit down with clients, I look at all of their insurance, so I look at property and casualty too, and take a look at it and see if it's meeting together and meeting the needs that they have, and are their liabilities on there correctly, and disability, whether they get disability through work or not, and long-term versus short-term disability, and if their company doesn't offer any, then that's a good place to start and have a conversation about that also.
If the client's specifically asking about insurance, first thing is health insurance, because you're probably going to get sick. So make sure you have some insurance there. And then, they have the life insurance in place. It should be reviewed. Do you need as much? What are the best types? Disability, once again, if you get sick or hurt, are you going to be okay? And depending on their age and asset level, is long-term care insurance suitable? As well as property and casualty, just making sure that the car's protected and the intangible assets in the home are protected, as well as the home. So.
Sure. Well, you said they had 4 teenagers, so the first thing they should be investing in is a psychotherapist to help them walk through that. But I think the first insurance product that came to mind certainly was home and auto. The liability implications of the party your kids have when you're on vacation, the liability implications that are attached to their automobile insurance, really fully understanding that, making sure that you're with the right carrier, that you have the right deductibles, that's going to end up being one of those types of things that they don't anticipate, because home and auto insurance, I think more than any other insurance product, has been so commoditized. Every commercial we see is, save X number of % with so many minutes, and obviously that's not the full understanding of that type of insurance product. So I think that home and auto is the first type of insurance and additional life insurance that comes to mind for that family.
Excellent responses. Thank you. Well, I think the question, what can a financial advisor do for me? This panel has shown that the first answer is, how much time do you have? Because there is absolutely, you've proven that there is absolutely quite a lot of value that you can deliver to your client base. So thank you all very much. Very informative.